Gold collapses, silver breaks, screens bleed red, and while most of the world stares at falling prices, something far more important is already moving underneath. No emergency meetings, no public warnings, no breaking news banners, just a quiet, documented shift of capital, executed patiently, measured in balance sheets, not headlines, treasuries exited, gold absorbed, silver constrained, payments rerouted, rules rewritten, 7 moves, all active, all already live. By the time most investors realized this was never a crash, but a repositioning, the opportunity to react may already be gone, because this story is no longer about markets, it is about who controls the system next, and that is where the real risk begins. Welcome to Boring Currency Ledger. If you are someone who remembers when money was backed by discipline instead of promises, consider subscribing. Not because it is fashionable, but because experience teaches that the quiet changes shape the future more than the loud ones ever do. And before continuing, let us know. Where are you watching from today? The collapse appeared decisive. Gold fell sharply. Silver fell even harder. Across global markets, screens turned red, and within hours a familiar narrative took hold. Analysts spoke of broken trends. Commentators declared the end of the precious metal cycle. For many investors, the conclusion seemed obvious. Falling prices meant the story was finished. But those who study systems rather than screens noticed something strange. When an asset truly loses relevance, institutions step away. Forecasts are lowered. Allocations shrink. Risk committees turn defensive. That did not happen here. In the days following the crash, some of the largest financial institutions in the world did not retreat. They doubled down. JP Chase raised long-term gold targets. Deutsche Bank held firm on elevated projections. Citi revised silver expectations higher. Morgan Stanley increased recommended gold exposure to levels rarely seen in modern portfolio guidance. This divergence mattered. Retail participants were reacting to price. Institutions were responding to structure. That gap between perception and behavior signaled that the decline was not a fundamental failure, but a liquidity event. Price is an output. It responds to leverage, margin requirements, and forced selling. Function is different. Function reveals how an asset is used within the system. In this episode, prices collapsed because leverage was removed. Function did not change. Futures markets rely on borrowed capital. When volatility rises, exchanges protect themselves by raising margin requirements. Following the sell-off, the Chicago Mercantile Exchange increased margins, forcing leverage participants to liquidate regardless of conviction. Selling became mechanical. Liquidity thinned. Prices fell faster than fundamentals could adjust. This process is common in leveraged markets. What made it significant was timing. The liquidation occurred while physical demand indicators remained unchanged. Industrial consumption did not slow. Inventories did not rebuild. Central bank behavior did not reverse. Yet price action suggested collapse. This is how financial distractions are created. Visual signals overwhelm structural ones. Investors are trained to react to charts, not balance sheets. As a result, liquidity events are often mistaken for thesis failures. At the same time, signals outside Western paper markets told a different story. Physical premiums widened in parts of Asia. Delivery demand increased. Price discovery in Shanghai diverged from Western futures markets. These were not signs of declining relevance. They were signs of stress. Gold and silver occupy a unique position. They are traded as financial instruments, but they also function as monetary reserves and industrial inputs. When markets are calm, those roles blur. When stress appears, they separate. Paper markets react first. Physical markets assert reality later. History shows that sharp declines in precious metals often occur mid-cycle, not at the end. Leverage is cleared. Ownership consolidates. Strong hands replace weak ones. The price tells one story. Behavior tells another. For business leaders and entrepreneurs, this distinction is critical. Markets shake out participants who rely on surface signals during transitions. Those who track capital flows, institutional incentives, and system design recognize these moments as inflection points. The crash was not a conclusion. It was a reset. Weak leverage exited. Structural demand remained. And when price and behavior diverge, behavior always matters more. What followed was not retreat. It was execution. And the next question was unavoidable. If capital was leaving one system, where was it going instead? When markets are calm, government bonds are treated as background assets. They sit quietly on balance sheets, assumed to be safe, liquid, and permanent. But when trust in the financial system becomes conditional, those same instruments turn into points of vulnerability. This is where the second part of the story begins, not with prices, but with capital movement. For years, one fact defined the global financial order. China was the largest foreign holder of U.S. government debt. Through its holdings of United States Treasury securities, China recycled trade surpluses back into the American financial system. This arrangement supported U.S. deficits, stabilized global liquidity, and reinforced the dollar's central role. It was not charity, it was mutual dependence. That relationship has changed. Public filings show a steady and deliberate reduction in Treasury holdings over more than a decade, accelerating in recent years. By the mid-2020s, hundreds of billions of dollars had been withdrawn. This was not a single political statement or a reaction to short-term interest rates. It was systematic. Year after year, exposure declined. To understand why this matters, one must first understand what treasuries represent. They are not simply bonds, they are promises. Promises that depend on political stability, legal enforceability, and access to settlement systems. When those conditions are unquestioned, treasuries function as the backbone of global reserves. When they are questioned, they become instruments of risk. The turning point was not inflation or yield volatility, it was precedent. When sovereign reserves were frozen during geopolitical conflicts, a line was crossed. Assets once considered neutral were revealed to be conditional. Ownership no longer guaranteed control. For reserve managers, this was not a theoretical concern. It was a structural warning. From that moment, holding large quantities of foreign government debt required a new calculation. The question was no longer, what does this yield? It became, can this be accessed under stress? China's response followed a clear logic. Reduce exposure to assets that depend on foreign custodians. Reallocate toward assets that sit outside the reach of political intervention. This is not an emotional decision. It is a balance sheet decision. Importantly, the capital did not vanish. Large-scale exits of this nature never represent liquidation for its own sake. Sovereign capital moves with intent. When hundreds of billions leave one asset class, they must appear elsewhere. Money does not disappear. It migrates. This is where many market narratives fail. Commentators often describe treasury selling as an act of aggression or retaliation. In reality, it functions more like diversification under constraint. China did not need to crash the bond market. It needed to reduce dependence on it. For business leaders, this distinction is essential. Strategic actors rarely announce transitions. They execute them quietly to avoid disruption. Visibility comes later, once positions are established. As treasury exposure declined, reserve composition shifted. Instead of paper claims tied to foreign legal systems, capital moved toward assets with no counterparty risk. Gold became central, not because of price appreciation, but because of ownership certainty. It does not require permission to hold. It does not rely on clearing systems to exist. This shift reframes how precious metals should be understood. They are not alternatives to bonds in a yield sense. They are alternatives in a control sense. In a world where access can be restricted, control becomes more valuable than return. The timing of the Treasury exit is also revealing. It did not stop when interest rates rose. It did not reverse when yields became attractive. That tells us the motivation was not financial optimization. It was structural risk management. At the same time, this process placed pressure on the existing system. When a major holder reduces demand for government debt, others must absorb the supply. Central banks step in, balance sheets expand, liquidity is created to maintain stability. This feedback loop weakens currency purchasing power over time, even if markets appear orderly. From the outside, this looks gradual. Inside the system, it represents a shift in how risk is distributed. Sovereign risk moves from holders of debt to holders of currency. This is why reserve reallocations matter far beyond bond markets. For entrepreneurs and investors, the lesson is not to fear treasuries or the dollar. It is to recognize signals. When a long-term participant changes behavior, it reflects a change in assumptions. Those assumptions shape future outcomes. China's treasury exit was not about selling America. It was about preparing for a world where financial access is no longer guaranteed. The move was defensive, rational, and incremental, and it set the foundation for what came next. Once capital leaves paper promises, the question becomes unavoidable. Where does credibility go instead? To understand the third piece of the strategy, one must forget how gold is usually discussed. In public markets, gold is treated as a trade, an asset that rises or falls based on sentiment, interest rates, or short-term momentum. For sovereign institutions, gold serves a very different function. It is not bought for performance, it is acquired for permanence. This distinction explains why recent price declines failed to change official behavior. While retail investors hesitated and funds reduced exposure, central institutions continued accumulating gold without interruption. The buying did not pause during rallies. It did not stop during pullbacks. It followed a fixed schedule, not a market signal. That behavior reveals intent. When an institution buys an asset regardless of price, it is not speculating. It is executing policy. Price sensitivity disappears when the objective is balance sheet protection rather than profit. This is how insurance is purchased. One does not wait for a fire to become cheaper before buying coverage. Gold occupies this role because it satisfies three conditions no paper asset can meet simultaneously. It carries no counterparty risk. It exists outside financial plumbing. And it is globally recognized without enforcement. These qualities matter most when trust between systems weakens. Reserve managers understand this. Their primary concern is not maximizing returns, but preserving optionality. In a world of increasing sanctions, capital controls, and payment fragmentation, optionality becomes scarce. Gold restores it. What makes the current accumulation cycle unique is not volume alone, but consistency. For more than a year, purchases continued month after month. There was no attempt to time entries, no effort to wait for better prices. This behavior contradicts trading logic, but aligns perfectly with strategic accumulation. To place this in context, consider reserve composition. Western economies hold a majority of their reserves in gold. This reflects decades of accumulated credibility. China's reserve structure looks very different. Gold represents a small fraction relative to total foreign exchange holdings. That imbalance is not an oversight, it is a starting point. When reserve gold ratios are low, future demand becomes structural rather than discretionary. Even modest alignment with global norms requires thousands of additional tons. This demand does not respond to price dips or rallies. It responds to policy targets. For business leaders, this matters because it reframes the gold market entirely. If the marginal buyer is a sovereign institution with a multi-decade horizon, then volatility loses meaning. Sharp declines do not invalidate the trend. They accelerate redistribution from weak holders to strong ones. This helps explain why gold can fall sharply while long-term forecasts rise. Institutions adjust projections based on supply, demand, and reserve needs, not daily charts. After recent volatility, major banks reaffirmed bullish outlooks. That reaction surprised many investors, but made sense to those watching flows rather than prices. Gold also functions as signaling collateral. When nations increase gold reserves, they communicate seriousness. Gold strengthens credibility in bilateral trade, currency swaps, and settlement negotiations. It reassures counterparties without requiring treaties or guarantees. This role becomes more important as global finance fragments. When systems compete, trust must be demonstrated, not assumed. Gold does that quietly. It sits on balance sheets as proof rather than promise. Another overlooked factor is custody. Gold held domestically is fundamentally different from foreign-held securities. It cannot be frozen, rehypothecated, or delayed by clearing systems. Ownership is direct. In an era where access can be restricted overnight, this distinction becomes decisive. This is why gold buying continued even as prices fell. Selling would contradict the very purpose of holding it. Insurance is not sold because premiums fluctuate. It is held because risk exists. From a strategic perspective, gold accumulation is best understood as preparation for multiple outcomes. If the existing system persists, gold provides diversification. If it fragments, gold provides settlement confidence. If inflation erodes currencies, gold preserves purchasing power. It performs under many scenarios without requiring prediction. That flexibility explains why gold is accumulated by both sides of geopolitical competition. It is neutral, scarce, and universally accepted. No nation controls its issuance. No central bank can create more. For entrepreneurs and capital allocators, the lesson is subtle but critical. Assets should be evaluated not only by expected return, but by function under stress. Gold's function is not to outperform equities in good times. It is to remain reliable when assumptions fail. The third piece of the strategy, therefore, is not about chasing higher prices. It is about rebuilding monetary resilience. Price volatility is noise. Reserve accumulation is signal. Once gold establishes credibility, attention shifts to the more fragile side of the system, where leverage is highest, inventories are thinnest, and demand is least flexible. That is where silver enters the picture. If gold represents stability, silver represents strain. This is what makes it uniquely important and uniquely dangerous within the current system. Silver does not behave like a traditional monetary asset, nor does it function like an ordinary industrial commodity. It exists at the intersection of finance, manufacturing, and infrastructure. That intersection is where stress accumulates first. Unlike gold, silver is consumed. Once it is used in solar panels, electronics, medical equipment, or advanced circuitry, it is rarely recovered. Recycling is expensive, inefficient, and slow. As a result, much of the silver mined each year permanently exits the market. This alone would make supply management difficult. But silver supply carries another constraint. It is mostly mined as a byproduct. Most silver does not come from dedicated silver mines. It emerges alongside copper, lead, and zinc production. That means silver output does not respond directly to silver prices. Even when prices rise, supply cannot be increased quickly. New projects take years to develop and are driven by demand for other metals. The supply curve is rigid. Demand, by contrast, is accelerating. Electrification, renewable energy, artificial intelligence infrastructure, and advanced manufacturing all require silver. These uses are not discretionary. Manufacturers cannot substitute silver at scale without redesigning entire systems. In economic terms, silver demand is inelastic. This mismatch has produced persistent deficits. Year after year, consumption has exceeded production. The gap has been filled not by new mining, but by inventories. Vaults have been drawn down quietly to bridge the difference. For a time, this process went unnoticed because paper markets masked physical scarcity. Paper silver contracts allow exposure without delivery. They multiply claims on the same underlying metal. In normal conditions, this works because few participants demand physical settlement. Confidence holds the system together, but confidence depends on availability. As inventories shrink, that confidence becomes fragile. This is where recent developments matter. Exchange-tracked silver stocks have declined significantly over the past several years. At the same time, large quantities of silver have moved into industrial use and strategic reserves. Once embedded, that silver is effectively removed from circulation. The result is a market with declining buffers. When buffers fall, volatility rises. This explains why silver price movements are often more violent than gold's. It is not because silver is weaker, it is because the system supporting it is thinner. Another factor amplifies this fragility: geographic concentration. A significant portion of refined silver supply flows through a small number of jurisdictions. When export controls, licensing requirements, or policy restrictions appear, global availability tightens immediately. Even minor disruptions ripple through the supply chain. From a strategic perspective, controlling silver flows has outsized impact. Because inventories are low, small changes in availability produce large effects. This makes silver a leverage point within broader economic planning. For business leaders, this matters because silver underpins modern infrastructure. Energy systems, data centers, vehicles, and medical technologies all depend on it. Price is only one variable. Availability is the critical one. When supply chains tighten, production slows regardless of price signals. This creates a paradox. Financial markets may show falling prices due to leverage unwinds, while manufacturers face rising procurement risk. Both can occur simultaneously because they operate in different layers of the market. Silver's recent price collapse followed this pattern. Leverage in futures markets was cleared rapidly, but physical indicators did not improve. Deficits did not close. Inventories did not refill. Industrial demand did not decline. The fundamental pressure remained intact. In fact, price weakness can worsen the situation. When prices fall, recycling becomes uneconomic. Secondary supply dries up. That pushes more pressure onto primary production, which cannot respond quickly. The system tightens further beneath the surface. This is why silver should not be analyzed through the same lens as other commodities. Its dual role creates nonlinear outcomes. Small shifts in policy, trade, or demand can produce disproportionate effects. For entrepreneurs and investors, the lesson is caution and awareness. Markets with high leverage and low inventory are prone to sudden repricing. Stability is an illusion maintained by confidence. When confidence is tested, adjustments are rapid and unforgiving. Silver is not failing, it is being stressed. And stress reveals structure. Within the broader strategy, silver functions as a pressure amplifier. It exposes weaknesses in supply chains, financial plumbing, and inventory management. Those weaknesses matter far beyond the metal itself. Once pressure builds in physical markets, attention turns to how transactions are settled, debts are cleared, and trust is enforced. That leads directly to the architecture supporting global payments. The next piece of the story moves away from metals and toward the systems that move money itself. Most people believe money moves because governments decide it should. In reality, money moves because infrastructure allows it to. Payments systems, clearing networks, and settlement rails determine which currencies dominate and which ones remain dependent. Control the pipes, and control follows naturally. This is the fifth and least visible piece of the strategy. For decades, global trade has relied on a single settlement architecture. Cross-border payments flowed through a centralized messaging and clearing network anchored in the US dollar. The system offered efficiency and scale, but it also embedded dependence. Access was conditional. Transactions could be delayed, blocked, or reversed. In moments of political conflict, this infrastructure became a tool. That realization changed behavior. When sovereign reserves were frozen and international payments disrupted during recent geopolitical crises, a precedent was set. Financial infrastructure was no longer neutral. It was revealed as jurisdictional. For countries engaged in long-term planning, this was not an inconvenience. It was a strategic vulnerability. The response was not confrontation, but redundancy. China accelerated the development of an alternative settlement framework designed to operate alongside existing systems. The objective was not to replace the dominant network overnight, but to ensure continuity under stress. Parallel systems do not need to be larger to be effective. They only need to exist. The cross-border interbank payment system, known as CIPS, serves this function. It enables international payments denominated in yuan without routing through dollar-centric clearing. Participation expanded steadily, connecting banks across Asia, the Middle East, Africa, and parts of Europe. Volumes grew year after year. This growth is often misunderstood. Analysts compare transaction size to that of SWIFT and conclude the threat is minimal. That misses the point. Strategic systems are built for resilience, not dominance. The goal is optionality. Once a second route exists, behavior changes. Countries conducting trade no longer need to rely exclusively on one network. Settlement choices diversify. Over time, familiarity replaces novelty. Infrastructure adoption is slow until it is irreversible. Alongside payment rails, trade settlement practices shifted. A growing share of Chinese trade began settling in domestic currency. This reduced exposure to exchange risk and external liquidity constraints. For counterparties, it offered access to Chinese markets without dollar intermediation. Currency settlement is not symbolic. It shapes reserve needs. When trade settles in yuan, reserves adjust accordingly. Demand for dollars declines incrementally. Demand for alternative stores of value increases. This is how monetary influence migrates. Quietly, through accounting decisions. Debt conversion added another layer. When sovereign borrowers convert dollar-denominated obligations into yuan-denominated ones, financial gravity shifts. Servicing that debt requires earning yuan. Trade patterns adjust. Payment systems realign. One conversion alters an entire financial ecosystem. This process is subtle but powerful. No treaties are required. No announcements are necessary. Each transaction reinforces the new architecture. Over time, reliance on the old system diminishes without confrontation. Digital settlement platforms accelerated this transition. New technologies allowed near-instant cross-border transfers without traditional intermediaries. Participation by major commodity producers signaled credibility. Once energy trade begins experimenting with alternative settlement channels, attention follows. For business leaders, these changes matter even if they appear distant. Payment infrastructure affects transaction costs, currency risk, and access to markets. Companies operating internationally depend on smooth settlement. When systems fragment, adaptability becomes essential. The metals accumulated earlier in the strategy support this architecture. Gold strengthens confidence in currency arrangements. Silver underpins the industrial systems that power digital and energy infrastructure. Together, they reinforce credibility where trust must be earned rather than assumed. Importantly, this shift is not about eliminating the dollar. It is about reducing dependency. Redundancy is not rebellion. It is risk management. From a strategic standpoint, building alternative payment routes while maintaining access to existing ones is optimal. It allows flexibility without disruption. That is why the transition appears gradual. Speed would invite resistance. Patience avoids it. Entrepreneurs and investors should recognize this pattern. Structural changes rarely announce themselves loudly. They unfold through plumbing, protocols, and policy alignment. By the time they dominate headlines, positioning opportunities have passed. The fifth piece of the strategy shows that monetary power is no longer just about currency issuance. It is about settlement control. Those who can move value without permission gain leverage quietly. With payments rerouted, trade settled differently, and reserves rebalanced, the final question emerges naturally. What does this mean for the existing monetary order? That question defines the sixth and final part of the story. The final piece of the strategy is often misunderstood, even by experienced market participants. Many assume the story ends with the collapse of the US dollar. That assumption is incorrect. What is unfolding is not a sudden breakdown, but a gradual loss of monopoly. The difference between those two outcomes is critical. For most of the modern financial era, the dollar has operated as the uncontested center of global finance. Trade was priced in dollars. Debt was issued in dollars. Reserves were held in dollars. This dominance was not only economic, but psychological. Trust in the system reinforced itself. That system is not disappearing. It is being shared. Even today, the dollar remains the largest reserve currency in the world. It is deeply liquid, widely accepted, and backed by the world's largest capital markets. In every major crisis of recent history, capital has rushed toward the dollar, not away from it. This has not changed. What has changed is exclusivity. Over time, the share of global reserves held in dollars has declined. Not dramatically, not suddenly, but steadily. This erosion reflects diversification rather than panic. Central banks are not abandoning the dollar. They're reducing single-point dependence. This distinction matters because monopolies create fragility. When one system dominates completely, failures become systemic. Redundancy reduces that risk. From the perspective of sovereign planners, diversification is not an attack. It is prudence. China's strategy reflects this logic. It is not attempting to replace the dollar as the sole global currency. That would require open capital accounts, deep bond markets, and legal structures that take decades to build. Instead, the focus is on optionality. Gold plays a central role here. It sits outside currency competition. It does not belong to any one nation. In a world where multiple systems coexist, neutral assets become more important, not less. This is why both established and emerging powers accumulate gold simultaneously. It supports credibility without confrontation. Silver complements this role differently. While gold anchors trust, silver anchors function. Modern economies depend on silver for energy, data, and manufacturing. Control over silver supply strengthens industrial resilience. In a fragmented world, material security matters as much as monetary policy. Together, these metals form a foundation beneath shifting financial arrangements. They do not replace currencies. They stabilize them. The broader lesson is about transition speed. Financial orders do not end overnight. They evolve through overlapping phases. Old systems continue operating while new ones gain traction. For years, both appear functional. Then suddenly, assumptions change. This is why many observers misread the moment. They expect a dramatic event, a currency collapse, a default, a reset. Instead, they are watching a slow redistribution of influence. Percentages shift, settlement choices change, reserves rebalance. None of this feels urgent until it becomes unavoidable. For business leaders and entrepreneurs, this environment demands a different mindset. Success no longer depends only on growth, but on resilience. Exposure to a single system carries more risk than before. Flexibility becomes a competitive advantage. The end of monopoly also reshapes opportunity. As financial systems diversify, new channels open, trade routes expand, settlement options multiply. Those prepared to operate across systems gain leverage. Those anchored to old assumptions fall behind. Importantly, this transition does not favor chaos. It favors preparation. The most successful actors are not those who predict collapse, but those who adapt early. They study flows, not headlines. They watch behavior, not commentary. This is where the story comes full circle. The price collapse that opened this narrative was not a signal of failure. It was a stress test. It exposed who was operating with leverage and who was operating with strategy. Those distinctions matter more as systems evolve. The 7 pieces, capital reallocation, gold accumulation, silver control, inventory management, payment infrastructure, trade settlement, and policy alignment, form a coherent framework. Each reinforces the others. None require sudden disruption to be effective. The dollar remains powerful, but power shared is power constrained. In that constraint, neutral assets regain importance. Control shifts from promises to possession, from speed to security. For those paying attention, the warning is clear but calm. The future will not reward certainty. It will reward adaptability. The question is not which system will win. The question is whether decision makers are prepared for a world where no single system decides everything anymore. Those who understand that distinction are already repositioning.